Hello and welcome to Your Money, Your Call. I'm Julia Lee from Bell Direct. This is a special shares edition brought to you straight from the Australian Stockbrokers Awards in Sydney. And we're going to be joined by a range of experts to answer your questions and your emails. If you would like to send in an email for future shows, please email us at yourmoney@skynews.com.au. And in this very special first segment, we're joined by Ben Clark from TMS Capital and also Andrew Tracy from JB Weir. I think one of the things that a lot of investors have been talking about and thinking about is how bond yields impact on the market. So, Andrew, we might start off with you. Where do you see bond yields heading at the moment and how do they impact on the market?
Yeah, it's a fairly common topic around the market at the moment, not only here in Australia but also internationally. I think if we look at our Goldman Sachs forecast, the Fed is due to be tightening rates in the US. It was in September and they're now pushing that out to December of this year. In Australia, I think there was last I looked at the futures market, there was another rate cut priced into the market. But when you're looking at bond yields, the risk-free rate is an input into every valuation that you value companies at on the ASX. So if you're looking at an industrial company and bond yields are rising, then you're going to have a consummate effect in a falling in the valuations supporting those share prices. So I suppose the best way to give an example of that is if you go back to the 1990s, interest rates, a lot of the investors will remember interest rates were at 17%, came all the way down to 7% throughout the 90s. And all the retail investors who were holding bank shares had a fantastic run of bank shares through that period. As the interest rates came down, the valuation support jumped up to support the rising share prices that we saw over that period. So that was one really good aspect of it. I think we're now at that other point in the cycle where rates are starting to tick up at the long bond end. So the risk-free rate is ticking up. So some of that valuation support will start to be dialed back from the market. So high yield industrials, long duration assets like tollways, infrastructure, transmission, utilities, telcos, those sort of ones will start to have their valuation support pull back when the market starts to see the rising rates actually come through.
Okay, so maybe a little bit of cautiousness in terms of some of those yield stocks, and it's probably a good time to go to our first email of the night. This one comes from Laura, and Laura asks, what's your top recommendations for dividend stocks? So we'll go to you, Ben. Yep. Do you think it's a good time to be thinking about dividend stocks, and what would be your picks in this space?
I think everyone's thinking about dividend stocks because of, the sheer wave of people hitting retirement and the alternative, the cash environment that they're coming into. I think what Andrew said there is absolutely right. So one thing I'd say is that you want to look for probably companies who have got net cash or little levels of debt, because that is one impact. If you look at infrastructure assets as an example, a lot of their debt's priced over long bond yields. So that's going to become more expensive and their earnings are going to have to grow faster than that to keep growing. One we've been buying recently, I won't go into all of them, but is Dulux, which has had about a 12% sort of pullback recently. But we think it's a business that's on a yield of about 5.3%. And I'd say, Julia, that it's not just important to look at the dividend yield now, but it's where it'll be in the future. You want to buy that growing dividend yield because you'll get capital growth along the way as well, but your spending power will stay ahead of inflation. And Dulux looks good to us in that new housing construction and renovation activity we think is going to be really strong for the next 3 to 5 years on the East Coast. Mike Baird's fast-tracking 400,000 new homes. Dulux controls 90% of the paint market. It's got a return on equity of nearly 40%. It's one of the highest in the market. It's a very good quality stock. So that's one I've sort of been talking to clients about in terms of investing in.
Okay, so some really good points there. The rising bond yields impacting on highly geared companies, so companies with a lot of debt, but also looking for that growth in earnings from companies like Dulux to help support that dividend. And Andrew, it's probably a good time to be talking about banks, something that we traditionally associate with the yield trade. And we do have an email here from Mike. Are the banks a buying opportunity at current levels? So given what you said about the the bond market, what do you think of the banks? Would you be buying?
I think the banks at the moment, we've got a reporting season coming up in August at the moment, and I think that'll really judge the sentiment of the market for the balance of the year. Retail clients should probably have somewhere around about 40% of their portfolio in banks. And because of that spur we saw in the 1990s of banks having a great run, a lot of retail clients have got significantly larger holdings than that. We don't have a problem having exposure to the banks. In fact, for the next period up to and including that reporting season, we see them as a bit of a safe haven in the market. So investors can hide in the banks, for want of a better word, because there's a lack of earnings risk in there. We've seen a lot of highly rated stocks in the market get smashed in the last couple of days. disappointing in earnings and numbers that have come through to the market. So the banks are a nice safe haven at the moment. But with rising bond yields, and we've actually seen the sector now go come issue with NAB raising $5.5 billion. So they've tapped the market for that, which I think is a good move for them to do that. The regulator will keep talking and making more noises about banks having more capital. So it wouldn't surprise to see other capital raisings other than the organic capital raising that the banks are doing. So that's one thing that I think investors don't want to be massively overweight the banking sector at the moment. And in the short term, will be somewhere to hide from the uncertainty of earnings in the reporting season.
Okay, so no rush to be overweight on the banks, but you probably want some banks to participate in that capital raising.
If you're sitting at 60% banks, you might want to have a look at that. But if you're sitting at 35 to 40% banks for a conservative retail client, that's pretty happy.
Okay, and would you agree dialing down some of that exposure on the banks?
Yeah, I think so. I mean, I think the banks are coming into a period where earnings growth is going to be lower than it has been for the last few years. Like, they've pretty much done all they can on bad and doubtful debt provisioning. That's at historical lows. Interest rates are close to historical lows. Housing prices are close, are very, very strong on the East Coast again. So you wonder if the conditions are about as good as they can get whilst they're also having to raise capital. But I agree that they're a good safe haven. NAB's the one we prefer, and I think you can still buy that on 8.6% gross yield or so. And, even if you just get a couple of % capital return from here on top of that, that will still turn out to be a pretty good investment, I reckon.
Absolutely. So very nice yield there from some of the banks. We do have another email from a viewer. So let's go to this one from Andrew. And Andrew asks, what's your view on SEEK? Should there be long-term concerns? Should I be selling off some of my holdings? It's done very well over the last few years. Now, we know that SEEK, a problem in terms of its learning division, and that's really impacted on its price. We're in the middle of confession season. Is this an opportunity to be accumulating shares, Ben?
Yeah, look, I think it probably is. We've owned SEEK for about 4 years now, and we've actually been adding a bit more money into it over the last couple of days. We know the business pretty well, and when you look at consensus analyst valuations, the SEEK Learning division is worth somewhere between 50 and 80 cents in their overall valuation of the group. So even if that business is now worthless, and this has happened because TAFE New South Wales IT systems have blown up and no students can actually get into the SEEK Learning system at the moment. Even if that division was worthless, it doesn't warrant a $2 share price for. However, it trades on a high PE. It was priced virtually for perfection, and when you don't get perfection, there's going to be disappointment and a pullback, and it could easily underperform, I reckon, for the next 6 to 12 months. But I think the attraction to us is the international business, Xiaoping, and the emerging markets that they're moving into. That will now be over 50% of the overall group's revenues, and there's a lot further to go, we reckon. And you've got Andrew Bassett there steering the ship, who I reckon is one of the best CEOs I've come across in the market. So he's reinvesting into the placement market, which should be good domestically. And I reckon the pullback, with a long-term view, I wouldn't say, trying to trade it or anything, I think you'll do well. Okay,
so you think that the traditional domestic market, which is looking pretty saturated, is going to be less of earnings, and you're going to see the international component take a bigger part?
Andrew Bassett saw this 10 years ago, which is why he started to go offshore. And as opposed to like REA or car sales, who will come much later to the international party, paid much higher prices to these international businesses, he's built them from the floor up. And they're now like number one in massive economies, and could go on to become much bigger companies than SEEK Australia. So, but you've got to have that long-term view. You've got to monitor it. But yeah, we like the stock.
Okay, so that was SEEK. And our final email comes from Jackson, and we're back to talking about bond yields and the impact on equity markets. He asks, there's a lot being made of the US raising rates maybe twice this year. Is that a realistic probability, and what does it mean for our market? So, Andrew, what do you think? The rising yields?
As I mentioned in the introduction, I think we're looking for the tightening in the US market was in September, is now being pushed out to December. The market's always going to have different views on when these tightenings will actually happen. I think if you think back probably 6 or 12 months, or 12 to 18 months, I should say, there was some expectation by the market that the Fed were going to start to tighten then. And we saw a real lot of dislocation in financial markets, and we saw some of the emerging economies really cop the brunt of that from a currency perspective. So I think there will be definitely a tightening there, and it will happen here in the Australian market. You've already seen the market start to tick up at the long end of the curve, both in the US and also here. So that will have the flow-on effects into valuations for those high-yielding industrials. But I don't know know about 2 rate rises, but definitely there's some coming later this year.
Okay, so definitely 1. The market hasn't priced in 2, so if we see 2, that might be a negative for equity markets. And I guess that brings us to our first segment. I'd like to thank both of our guests for a fantastic start to the show. Ben Clark from TMS Capital and also Andrew Tracy from JB Weir. We do need to go to a break, so we'll be back with more straight after this.